Hello, this is Stephen Evans, and I would like to make a presentation about our investment strategy and our new global model. We work with a number of investment partners, including Dimensional and Vanguard, and through them we're able to gain exposure to all areas of the world stock market and bond market. This chart shows the allocation of world stock markets, and you will notice that the United States is by far the largest market with 54% of world valuations. The UK is 5%, which is much less than it used to be. It used to be 10 to 12%. And you will also see that China, in terms of its free-floating stock market, which international investors can access, is now growing to 6% as part of the emerging market sector. So we advise clients to approach investment as a global investor and to allocate their resources accordingly across all world markets so that they can gain the benefit of the growth where those markets are growing and diversify across those markets which may not be growing as fast. So this chart over 30 years shows the returns on different classes of investment. For example, investing in treasury bills, short-term bills over 30 years with interest reinvested would give a total of £4. If you had invested in world equities across all 12,000 quoted companies with dividend reinvested, you would have achieved £13 from £1. But the interesting thing is that if you had invested in smaller companies, which are defined as the bottom third of the market in terms of company size, but still quite significant companies with an average market capitalization of 2 billion, then you would have achieved a higher return of £22. Also, with what are termed value companies, which are those which have a relatively cheap share price relative to net asset value or price earnings ratio, if you had continuously invested in the value sector, again, the bottom third of the market in terms of price, then you would have achieved an enhanced return of £19. So these are long-term trends within financial markets that we seek to take advantage of. And you will also note that emerging markets have performed even better than the developed markets, but of course they are more volatile and more risky, but they do have a place within the portfolio. So our simplified global model is reduced down to 8 funds, but with the same diversification and risk profile as earlier models. And in this case, 60% in equities, diversified across the world, and 38% in higher quality government and corporate bonds to reduce the risk of the portfolio and to reduce the volatility. When shares go down in value, the value of higher quality bonds tends to go up because they are a safe haven. And if you're already holding them, then you get the benefit of a rise in value to offset the potential fall in share values. So this is a typical model that we would recommend as part of the financial planning process over the medium to long term to build up funds towards your objectives, whether that is retirement plans or assisting the next generation in your families, whatever the long-term financial planning goals are. This is the engine which drives the car towards your destination. So in terms of outcomes, uh, Vanguard have a very strong research capability, and they do give an indication of what they expect in terms of returns from standard portfolios. So a 60-40 portfolio, they would expect on average over the next 10 years, a return of something like 4.6% per annum. As you go up the risk scale, then 100% equity might give 6.6% per annum. These are averages, and there will be years when the returns are negative, but by sticking to your goals throughout the medium to long term, you have the greatest likelihood of achieving positive returns. These returns are not as high as they have been in some other periods, but they are positive and they are above the rate of inflation, which is expected to be in the region, well less than 2% per annum. So overall, it's a positive outlook. Financial planning does make sense. Having the right investment strategy to drive that plan is sensible, and we would recommend continuing with the long-term investment strategy to achieve your goals. Well, thank you very much for listening, and do let me know if you have any queries, and goodbye for now.